Oh man, United Healthcare stock, we got to talk about it. Year to date, the stock is down 50%, which is about $254. So let's go ahead and take a look at this stock, see why it's dropping in price, and find out what the intrinsic value is. If you didn't know, UnitedHealth is a insurance and healthcare service company that is based in Minnesota. They're one of the biggest companies in the healthcare industry or the healthcare sector in the United States. As you can see, their market cap is 226 billion, so it's no small company, and it pays a great dividend yield of 3.54%. And also take a look at the PE ratio for such a huge company. We're going to take a look at this compared to the EPS and the share price to determine how good this actually is. One of the reasons why United Healthcare is dropping is because they missed on earnings and they had a guidance cut for 2026. Now keep in mind that a lot of companies are doing the guidance cut for 2026 due with all the changes that the current president of the United States is making in terms of tariffs. So this isn't the only company doing this, and it's not the only company being affected by it. However, there's a lot more things that are affecting the stock price for United. For example, in Q2 of 2025, the adjusted EPS of 4.08 missed analyst expectation. The analysts were expecting for the EPS to be 4.48. However, they did not have a double miss. That would have been terrible. The revenue was slightly up to 111 billion. Now, for the rest of the 2025, their EPS was adjusted down to 16, well below the earlier adjustment or the target that was about 29 or 30 per EPS. Now, not only that, they have been increasing their prices. United Healthcare, since they are such a huge company, they have a lot of moat. They have a lot of customers subscribed to them already, and medical healthcare stock companies make a lot of money with the customers they already have because those customers tend not to leave, and that's why they get to increase the prices so much. So they climb a total of 89.4%, which is 4.3% higher than previous years. Obviously, this is driven by unit costs, and they're going to use the excuse of tariffs and everything like that. They also saw a 7% decline in their pharmacy benefit business, which is not very good when it comes to investors. Usually when a company buys companies or they buy out other companies, investors want to see those companies make profit as well, making it seem like a good acquisition by the parent company. Now, not only that, something that investors hate is that they have been changing CEOs. And if you know other CEO, what happened to him, I'm not sure if I can mention it on YouTube. I'm not going to say it, but you can research that on Google. Plus, United Healthcare is under investigation, including criminal and civil activities for alleged Medicare Advantage billing fraud, raising fears of regulatory sanctions or settlements estimated to 1.6 billion. If you take a look at the overall cash this company has, 1.6 billion is really not going to hurt it, but still the news that is under federal investigation is scaring investors away. Now with this, like I just said, the investor sentiment and the market impact has not been very good. Apart from this company having all of this going on, the healthcare sector in general is at its weakest time in a lot of years with companies like Pfizer, Moderna, Johnson & Johnson. They're all dropping in price. Now, one thing apart from the numbers that we're going to take a look now that I do like about this company, or that gives me hope if I were to invest in this company, is that they are buying back their shares. Okay, so what does this mean? Usually when companies buy back their shares, they believe that their stock is undervalued. So they're buying these shares because in the future it's going to be worth a lot more, and then hope in the future they're probably going to start selling them again. But right now, if the company is doing all of this and there's still people buying the company, or the company itself is buying a little piece of itself, if that makes any sense, it's usually a good sign they believe that they're going to turn this over. Now, if we take a look at the stock price with the PE ratio and the net EPS, we can go ahead and see that the PE ratio has been the lowest it's been since 2012, and the stock price has been the lowest it's been since about 2019, but the EPS are still almost too close to being the highest it's ever been. So in summary, we're getting a stock that maintaining their EPS, obviously they just cut their guidance. The stock price is lower than what it was in the past, making the same EPS, and they have a PE ratio that has been the lowest since 2012. So you have a cheap company making more profits at a cheaper stock price. I don't know. In my idea of investing, if you want to invest for the long term, these are usually those stocks that you want to look for. They don't always play out, but this is some of the things that I tend to look for. Again, I'm not a financial advisor, so please do your due diligence. So let's get into the intrinsic value of the stock. Now, if we take a low estimate of a growth rate projection of 6, you could see the ticker symbol UNH. This company's intrinsic value in the original Graham formula would be $473. In the updated formula, it will be $420, and in the revised analyst formula, it will be $266. Within all of this, as you can see, the stock price is currently $249. If you were to buy this stock at a margin of safety of 35%, meaning you buy it 35% lower than what it is intended to be worth or what the intrinsic value is, you could buy this stock at $273, and again, it's at $249. So if you think this stock's outcome is good, if you see a future for this stock, now might be a good time to start looking at it. Again, I'm not a financial advisor. Please do your own due diligence. Or if I were to bet in stocks with the minimal risk and the highest profit possible, which doesn't seem like a good idea now because there seems to be a lot of risk. But when you do the numbers in comparison to what you could lose to the upside advantage, this would be a good bet in my opinion. Again, it's just my opinion. I'm not a financial advisor. And just again, guys, taking a look at a similar chart, I mean, you can see the APS all the way up here and the price is not following. Usually when this happens, the company tends to be good. It's just with everything going on, you know, they're still making more sales, yet the stock price is dropping. Everything else has been dropping, but in 10 years and 5 years estimates, this should be back up again, in my opinion. Another great thing, this company has more assets and liabilities. You always want to see this in a company, in any type of company. And apart from the dividend yield, as we just saw, their buyback yield is 1.5%. This is what I just showed you, that the company is buying back their own shares. And if we're taking a look at how safe the dividend is, as you can see, a 3.54%, which is about $8 per share. And that is only a payout ratio of 33%, which is great. They have a 5-year growth rate of 13.64. That means that over 5 years, his dividend is going to go at a 13.64 rate, obviously. And they have a dividend growth of 15 years. That means they haven't cut their dividend in 15 years. However, with everything going on right now, it wouldn't surprise me if they cut their dividend, and that would definitely make the stock fall even more. And then I think probably that's when I want to start going in heavy in the company. Once again, in my own opinion, I'm not a financial advisor. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you in the next video.